Secondly.
Yes, sir. This is Bhagya. I just joined to the program.
You're from?
I'm from Sampath Bank.
All right. You went to risk or?
Not actually. I'm into credit.
Are you into credit?
Yes.
So you're dealing with risk anyway, no? Credit risk. Okay.
Yeah, of course I do.
Right. Thanks. Anyone else?
Yes, I also just joined today. I'm from Emirates Islamic from Dubai.
Right. Okay. So what is the area you're into?
I'm into operations, but mostly compliance as well.
All right. Okay. Great. Is that all?
Hi,
Yeah.
sir.
Yes, no.
Sorry. Yeah. So yeah, I'm Navodya. This is also my first class.
You're from?
I'm from Acuity Knowledge Partners.
Equity. Yeah, okay. So you're non-banking participant. Have you been to the banking sector before?
Yeah, I worked at Cargill's Bank. So
Ah.
I basically work as a credit analyst, so into banking.
Okay, great. Welcome. Anyone else? I heard another voice earlier. Right, never mind. So those who joined today, we just started last week and we haven't even finished the chapter. We just went through the basic things. You can look at the notes. You can even get access to the video last session so that you can recap what was what you couldn't catch last time. And if you have any questions, clarification, you can always ask so that I can clarify them. So we are still at the early stages, so we didn't go to very complicated areas. So okay, let me share the presentation. Right. I think this was the slide we touched last time, right, at the end. So we started working on it and then we were looking at the sources of risk. Where do we get the risk? Then we discussed about the external sources of risk and then how we assess the external sources of risk. Now, the next one is internal drivers of risk. So when you say internal drivers, that is the other side, because we discuss how we can get the risk from outside. And now we're looking at, right? You can see the screen, right?
Yes, sir.
Yes.
Can
Ah,
see
okay.
it.
Great, great. Okay.
Yes, sir, can see.
Right. Is the screen disturbed now or am I?
Yes, the audio.
No, it's clear, right?
Yeah, clear.
Right. Okay, great.
So your audio is a bit low. Can you please check?
Sorry? Audio is not clear. Is that the case for others as well?
Yeah, it's fine now, sir. Thank you.
Right. So we were looking at internal drivers of risk. So we can look at many things when you talk about internal drivers, but what they've done is they've categorized or put all of them into broader buckets. Right? Then we can talk about each item that we identify or each risk factor we can park under each of these buckets. So the first one is called the strategic risk. Strategic risk, it has two components. that we know what strategy is. Strategy is about how an organization wants to drive themselves, so how they want to achieve their goals. So then they decide different approaches, techniques, some actions that they want to do so that they'll get there. So when you do this strategic planning, you come up with some strategies that you want to execute to achieve your goals. But not every organization is able to realize all the strategies that they design or that they want to execute. So what happens is, when you execute at some point in time, these strategies won't work. Sometimes you get unexpected negative consequences or results, or you get situations where your strategy cannot be implemented. You get those things. So here what we're looking at is, when an organization has a game plan to achieve their goals, why they are unable to make it. That is the risk that they face. So there are two sides, as I told you, right? You look at the design of the strategy, right? So you can have a strategy, but the strategy is not the right strategy for you. Or strategy has flaws, right? It has weaknesses. It doesn't address the real issues. So if the design is not right, your strategy may not work. It might not yield the results. Sometimes the strategy can be executed, right? It can be executed. So you have a plan and you execute it, but it may not yield results because that is not the correct strategy. So therefore, just because you're able to implement the strategy doesn't mean that your strategy is successful, right? So sometimes we get this wrong in organizational context as well, right? You design a nice strategy and you implement it, and then you celebrate, yes, we did it. Because I am heavily involved in strategic planning for many organizations, including banks, right? Then I see some of these weaknesses. Some people don't even get the real essence of what strategic planning is, right? And in the current context, people talk about, is it worthwhile even talking about planning in the current context, because the environment is dynamic. And then my response to them is, that is where you need to do more planning. Now, you might want to revisit your time horizon, right? You might not want to do 5-year planning at this stage, but you might want to do some kind of planning, because this is where you need to be mindful of all your resources. And every step that you make has to be careful in this context. There's no room or no margin for errors, no margin for experiments. So you need thorough planning and make sure that every step you do is a valid and important step. That's why it is important. Now, the design, if you don't address your strategy to achieve your goal. So when you do a strategy, the strategy has an objective, right? You are trying to get something on it. So I'll give you a basic example, right? Sometimes, okay, people say, okay, we had a strategy in when we want to expand our business. We had, this is one of the companies I met, right? So when I was discussing with the management, they say our strategy was to do aggressive marketing and we wanted to capture customers. So we had a strategy to invest on marketing and promotion. So we invested a significant amount of money on advertisements, so TV advertisements. So they had a plan, they had a strategy, they have executed the strategy, and there's no issue with that. But the problem is the sales. Did the sales actually pick up? And also, do you think that the amount of money you invested on these campaigns have really given you a return, yielded something tangible? Now, here is the catch that they have missed. They thought when you want to go to customers, you go and just look at what is the option that gives you a greater mileage. So they thought TV advertisement would be the best. In fact, they have gone ahead and sponsored a cricket match. So they can, when you put a advertisement in cricket matches, it costs you more, right? But when I look at the product and the customer base, this company was just selling some products within a particular district, right? Even within the district, they have covered only identified area. They haven't even covered the entire district. So when I asked the question, what is the point of you putting an advertisement in the TV for the entire country when your market is only this district or a couple of areas? You can easily have a targeted campaign, right? Activation or below the line or any other direct targeted activity at a lesser cost than what you have already invested and with more impact. And I just gave you one example. So likewise, you can see even in the banking sector or any industry, strategies fail first because of the design. The design is not correct. The second area the strategies fail is the implementation, right? At the implementation stage, the strategies fail, or the execution. How do you explain that? Because there are several aspects that affect why the implementation fails. One thing, when you design the strategy, you may have not paid enough attention to the implementation aspect, the resourcing, the competency of the people to implement, and other ingredients that are necessary to implement the strategy. On paper, strategy is good, but there are other things that ensures the strategy is implemented. So you have not paid attention to those, or you have undermined those aspects, and then the strategy fails. And poor monitoring, right? You know, do not monitor the execution from the beginning so that people will not act in line with what was planned, and there's no mechanism to make sure that they are kept in the track. And here is the other part, which is quite controversial as well. You may have all what it takes for you to execute it, but the environment may change. The environment might give you a different context than what you have planned. So when you design the strategy, you expect or anticipate a particular market condition or a context, a competitor move. But without your knowledge, right, there could be situations that are unexpected or you haven't planned for. So such situation might also make your strategy unviable or not effective. So therefore, there are a lot of aspects that we need to look at when you talk about the strategic risk. So we haven't gone ahead for the measurement and the rest of the risk that we discuss in the financial service sector. This is just a risk that any organization faces, not only the financial institutions. The next one is operational risk. I think the banking sector, we all know what operational risk is, right? This is not only for banking industry or financial services, it is for any industry, right? The risk, this is defined, I must say. So, right, in the book, it defines the risk of loss resulting from inadequate or failed internal processes, right? Internal processes, people, systems, or external events, right? Those are the causes. Internal processes, systems, people, or external events. Those are the causes that might lead to operational risk. And that is, I think I have explained this earlier as well. The operational risk is the largest type of risks. In other words, it is the risk that can have the highest volume of occurrences or opportunities in an organization. Because as I told you, it can be due to process issues, it can be due to systems, it can be due to people, it can be due to external events. So there are a lot of possibilities for an organization to have operational risks. As a result, there is a need for the organization to have adequate resources and a robust mechanism to identify and manage this risk. That is why in most of the banks especially, right, you have a separate operational risk team under the main risk domain. You have the risk CRO, then you have other people looking at different aspects, and operational risk is a special area that most of the banks have a separate team because in volume it is very high. Therefore, you need very resourceful mechanism to handle it, and also every day, right, you need to make sure that it is addressed. So you can't wait for these things. And the third category of risk, internal risk, is known as financial risk. So financial risk, again, can be broken down to broader risk categories, right? Especially in the financial services sector, we get this. We have the credit risk, we have the market risk, and the liquidity risk. These are all connected to financial risk. So we have separate chapters to discuss each of these risk types. So I will not spend time today to describe all of them because we have a deep dive later. Right. Let me move. So how do we assess internal drivers of risk? That means basically how an organization can get an understanding or make an assessment. What are the types of risks that we face? That's number one. Secondly, how do you measure, how do you identify the severity or the significance of that risk? You can identify a risk type, right? But how significant is that? Should we worry about it? Should we work on it? Should we manage it? Or probably there could be certain risk factors that we identify, but we don't want to do anything, we live with it because it's not a major impact to the organization. So therefore, it's important for us to assess it so that we know what it is, and then we can take a call how to deal with it. So how do you do that, right? I think this is applicable mostly in the financial services sector, but there are certain conglomerates and certain other organizations who practice these kind of things as well. It can be applied to any level, right? Although it is popular in the financial services sector. So one is called the risk assessment workshops. So what do you mean by risk assessment workshops? So what happens there is you have a team, right? You get the management or relevant people, not only in the risk, the business, in all areas. You get into a room and you have a workshop, right? It's more of a brainstorming kind of a workshop. Then you go through your entire organizational context. You look at your overall goals. What are the goals you have set up, right? Then what are the processes, products, actions you have identified? to execute so that you achieve your goals. And at the same time, you have a lot of activities taking place in an organization. So these workshops, what you do is you get everyone to talk from different angles so that you see different aspects of the organization and things. And then they identify where we think we have a risk, where we think we have an exposure. So these workshops will help you to uncover those areas based on the experience and expertise of the people in the organization at different levels. Another channel we can do this is by having a discussion with the external auditors. Because as part of the audit work, it is necessary for the external auditor to assess the risk, but their concern when they assess risk of an organization is predominantly from financial statement point of view. Right? Their job is to audit the financial statements and issue an opinion. So if they happen to review the risk of an organization, they will do that on the basis that such risks have an implication on the financial statements of the organization. Right? But the auditors will have a different eye than the management. They come with some expertise. They sometimes have their own tools that helps them to identify things. So likewise, you can look at how we when they give their version of it, how the organization can absorb it depending on the priority. And sometimes if you look at the management letter, right? If you are exposed to the external audits, so auditors are giving the management letter on top of the audit opinion on the financial statement. There also they identify some significant risk factors, and they recommend the management to take actions on this. Then we have stress testing. How many of you know what stress testing is? Anyone? Stress testing?
They put the company at a worst case scenario and check if they can still make profits when it comes to financials.
Okay. Thank you. Any other view? Any other views? Stress testing? Right. Stress testing, what happens is once you have a plan, or once you have some forecast, some expectations, or maybe a budget, right, that gives you the possible future of the organizations or your expectation for the next whatever the period that you want to consider. So first, to the base case, identify what is the expectation, no, what is the prediction. Then what you do is you take one variable at a time, right? So let's say you have planned for a growth in the organization in terms of profit. You may have factored your revenue, you have your expenses and then profit and all of them. You take just revenue, let's say. You identify, okay, what if our revenue drops by 10% than what we plan, right? So we plan for a growth, but it drops by 10%. What would be the situation? Then you can look at, okay, we talk about the cost escalation and we have factored something. Okay, we have factored 5% growth in the cost. Then you assume, okay, what if the escalation of cost or general level of increase is beyond 5%? We have factored 5%. What if it is 8%? And then how it is going to affect our bottom line and the rest of the financial predictions. So likewise, you do different situations, you identify such changes in the variables, and then you look at the impact. But there's one thing here. Whenever you look at this impact, you take only one variable at a time, right? So you take, okay, what if the revenue goes up, keeping everything else stable? What if the cost escalation goes up, keeping everything else stable, including revenue? Right? You take one variable at a time and assume that the rest of the variables are the same. That is what we call a stress testing. Then we have scenario analysis. So scenario analysis is the next level. For the stress testing, we take one variable at a time and move it up and down and see what's going to happen. In a scenario analysis, you identify scenarios, right? A scenario, a situation, complete situation. Okay, we assume a situation where the country is bankrupt. We assume a situation where we get a IMF bailout. You look at a scenario, a position, expectation, and then see if this scenario occurs, how do the rest of the variables get affected? So when a scenario is taken, it is not only one variable at a time, it can have multiple implications on multiple variables. So you look at that. So, okay, under this scenario, what can happen to revenue? What can happen to cost? What can happen to interest? Right? You identify all the areas where this scenario can have an implication on your numbers or your prediction. And then see what would be the outcome. You can, that's where we talk about the best case, worst case, right? Those scenarios if you have heard of, that's scenario. You look at what would be the best case situation. In the best case situation, how much revenue can grow, how far we can control cost, how would be XYZ different variables under this situation. So then you look at the end result, right? So this will also give you, so this is not just planning, right? We talk about planning, but from a risk perspective, how you look at this is, let's say you can see, okay, in a best case situation, this company can go up to this level and it's always positive. Okay, you assume the worst case situation. The worst case situation, you say, if we face the worst case, we will lose this much revenue. We will have extra cost like this. And eventually, this is going to be the impact on our bottom line. Okay, then you realize if the worst case that we anticipate materializes, the organization will run at a loss of X amount. Now you identify if the worst case realizes, what would be the impact on your organization? That's the risk. And then when you manage it, you will look at, okay, how best I can prevent that happening, right? Probably you might not be able to stop the occurrence, right? Or the external events or whatever the factors, you may not be able to control. It may be beyond your control. But what is within your control is how you respond to that, right? So if you predict it, if you identify through a scenario analysis that if this happens, we are likely to suffer on this side, then you can build that risk or risk mitigation measure into the plan itself. Okay, then you operate at a different level. Even if we get a 10% shock on our revenue, we still are safe. Or maybe we have a backup, right? We have alternative arrangement. If that happens, we will do that at that point. So likewise, you can look at it. So that's the importance of having this analysis, stress testing, scenario analysis. All that will tell you in under these circumstances, this is what could happen. Then are we ready to accept it? Or how do we deal with it? Right. Now, there's another interesting thing here. When you look at internal and external risk, right? It is easy to discuss these things in a textbook's environment. You identify, you can break it and identify separately. This is what this risk is about. This is what this risk is about. It's easy. You can talk about it. But in reality, it is not as clear as what we talk to demarcate different types of risks and identify them, right? Sometimes you get a mix of all kinds of risks, right, in a given scenario. Then how do you separate each risk is a challenge. But there are certain instances which is possible, but it's important to know. And at the same time, when you talk about the risk can come from external drivers, risk can come from internal drivers. Then how do you distinguish between internal and external, and which part of this risk is internal driver run one, or which part is other way around, right? That's overlapping. So if you look at this is a scenario given in the book, right? If an organization wants to launch a new product, right? You develop and launch a new product. Now, what are the risks, or how do you deal with it? I mean, when you launch a new product, how do you approach it? You do a gap analysis of the strategy. Is the way we approach the problem, is the way we are going to address this correct? Do we have any implementation issues which we have identified by? Remember the two things on the strategy part, right? Design and implementation part. That is what we want to do. And then at the same time, we need to know what is the market. What is the market? When you introduce a new product, are you sure that you have a sufficient market? Right? Now, I met a small timer who has started a saloon. Yes, invested quite a reasonable sum at his level to start the saloon. Then when I had a chat with this guy, I asked him, okay, how many saloons are there in your area? And he says, in my area, we don't have any salon. That's why I started this. Then I say, okay, how do you find a salon? How far away? Well, there's one next to our area, right? From my side, I have to walk around 500, 600 meters, right? Not too far from me because I'm at the edge. But when you go inside the village, there are a lot of other people. And at that side, we don't have a saloon. So I started this. So what he's doing is he want to avoid people going to the saloon in the other village, which is close by. And then he want to cater to that market. And he has invested a reasonable sum, as I told you, to put up this salon and the rest of the decorations and equipment, everything. Then I asked, okay, tell me how many people are there in this village, right? on a reasonable count. You don't need to be exact, just the number of families and average number of people in that families and all that. When we count the number of heads in the family, in those houses, and on a optimistic, right, which is beyond reality, I assume, I told him, okay, let's assume everyone in this village will get a haircut every month, which is highly unlikely. And then we'll calculate the revenue you are going to get. And I showed him, even if everyone in the village comes to his place for a haircut, he is not able to recover his cost. Right? His break even is very low. So he can't even recover his basic costs. Then only he realized, although there is an opportunity for me to put up a saloon because there is no one doing it, on a commercial basis, I'm not going to recover my cost by doing this here. That is why it is very important to do a market survey, right, and identify the demand, the potential demand. I gave you a very basic example, but the same logic applies for large organizations as well. So that's what we do to avoid that risk, because your break even should be greater than or less than the market size. People need to know which is the correct logic, right? If you don't know that, you can't do this. Then market research to understand any similar products. Yeah, very important. So we are avoiding our risk. This is what we do, right? We do research. Yes, I can't see my products being sold, but what if there are people who sell things that will be a substitute, that can be a substitute to what I'm going to do, right? Say, for example, a person is going to put up a, again, see, I'm just giving you basic things so that you can understand the big picture. A person wants to start up a cool spot, or you want to sell fruit juice. And this man looks around and sees there's no one is doing a fruit juice bar nearby. So therefore, I'm going to be the only person in this area doing fruit juice. But he forgot the fact that there is a king coconut seller next to his shop, right? He's been operating for some time. Now, he did not consider king coconut as a substitute to what he is selling, because he thinks, okay, I'm going to sell mango juice, orange juice, this and that. But isn't it a substitute at some point, right? Because you are trying to cater to the same segment. Who people want to drink something, people want to quench their thirsty, right? And then you have a task to switch those people who go to the king coconut sale also to come to you if you want to catch the market. So you to do that. Then research and development, right? Because you need to make sure that your product will not fail at the market. You do enough research and development. And then you also need to have sufficient dialogue and communication with the regulator and all those parties, because at the end, they can come and make your business unviable. They can come and create risk factors in your business. And this is another thing, test marketing. This is the latest way of doing marketing in many cases, because those are the days, or the gone are the days, we just publish an advertisement and let the customer look at the advertisement and come and buy the product. Now today we have what we call experiential marketing, right? People want to taste before you buy it. People want to experience before they buy it. So you need to go and do some test marketing where you get the people to experience it or taste it and then get their feedback. Based on that, you can find the product and then launch it. Now, here is an important point, especially large organizations. I always go and say, when I do these assignments with large organizations, the best crowd you can do your test marketing. Can anyone guess? What is the best crowd you can do test marketing? Any guess?
Employees.
Employees, absolutely. Your own employees. You just give it to your own employees and see how they feel it. Any feedback that is in-house, right? There's a lesser chance that they go and expose yourself because that's their family within the organization. So let them give the feedback and based on that, improve. So all these factors, as I can explain further, right? All these factors, as you can see, connected to risk. When you want to launch a new product, develop and launch a new product, these are the typical things that a rational organization would do in order to manage or mitigate or prevent the risk exposure. But the problem is, when you go through this list, it might be difficult for you to distinguish between what are the external factors, what are the internal factors, because they are somewhat gray in certain cases, right? Whether it is coming from outside or whether it is something to do with internal. So therefore, we have that situation. So when we look at the risk management, you may not be able to demarcate in all the cases. These are the external factors. These are the internal factors, because sometimes there is a mix of both. There are certain factors coming from the organization and there are other factors in the external market, and sometimes the combination of both can create certain risks. Therefore, the important thing here is that rather than trying to figure out whether it is internal or external, the fact that the organization identifies there is a risk, right? At least try to pinpoint where does this risk originate from. So we can address it at that point. Then we will get back to some terms or terminology and risk. We have discussed a few fundamental or basic terms, especially the risk and uncertainty. We discussed those things. Now, there are further terms that we need to know in this context. Risk culture. Now, you may have heard of this term culture in an organization. So what do you mean by risk culture? So you can see a definition here, but more than this, I would like to hear if anyone would like to contribute. How do you explain a risk culture in an organization? Anyone? How do you explain the risk culture? How do you understand? Don't worry about the technical terms.
Does it mean like can you say that if a company is like risk averse or risk taking, that also could be a part of culture, right? I'm just trying to understand.
Yeah, I didn't hear the middle part of your.
Say a company is either risk averse or risk taking or something like that, that also plays a part in the culture, right?
That, yeah, the culture is contributing towards that. Yes.
Yeah.
But what do you mean by the culture in that case?
So the staff, hello.
Yeah, go ahead.
So we try to in the organization make the staff aware of what to be like what points to be we need to look into or be aware of while we work daily, and then to make sure that the all the staff in the organization on a daily basis kind of know or aware what to do and what will happen if something goes wrong, and what needs to be done if they see something wrong happening, kind of that kind of culture. I mean, to build something like that in the organization.
Okay. Okay, that's how you educate people and give them that idea, right? Okay. Any other views? Good. Because I like to talk about these things in practical sense so that it's easy to remember.
Yes.
To what extent a company would want to take certain risks?
That's a different term. I'll come to that. Right? That's a different term. That is not culture. You have a point there, but that is a different concept. I'm talking about it in a while. That's your willingness to, yeah, the willingness of taking, how much you want to take.
Hello. Hi. Can you hear me?
Yeah, go ahead.
Yeah. Can we say it's the risk appetite for each organization, that how much risk they're willing to take? I mean, either positively or in the form of negative form as well.
Yeah, how much you are willing to take is appetite, right? As you just said.
Yes.
Yeah. So how do you explain the culture? Okay, don't worry about the risk culture. You talk about, sometimes we say, okay, that is the culture here, right? That is the culture of the organization. That is the culture of a country. That is the culture of in this village. That's the culture of the team. We talk about it, right? The word culture.
Yes.
How a collective, how a team of members while working deal with a transaction or deal with a situation, and when the situation arises, what needs to be done, and how to come out of that kind of situation. How they behave in a scenario if a fire taken place, how it should be. We bring some experts and we educate the staff. If and while educating, after we do some kind of fire drills kind of things, how they will behave like that. It can be, and how it will be treated, how those kind of scenarios, how an organization will act for a situation, and
Yeah.
how prominence the management will be dealing with this kind of activities.
Hello.
Yes, great. Yes, go ahead. Thanks for that.
The level of understanding or awareness of employees when there are challenges that they have to face, how they react on those, like the level of awareness to react to those challenges when they are going to meet.
Okay, level of understanding.
Yes, when there are challenges while the business is going on, how they should react, like to minimize the bad impact to the business.
Okay. Great.
It is something that the staff inculcate an awareness about the risk, our risks in the organization. It gives the some kind of values to the staff of the organization, and it will be inculcate, and it will be a day-to-day practice of the of that particular organization.
Okay. Yeah, your explanation is somewhat similar to the previous one. Yeah, somewhere there. Yeah, I can see some messages as well. It is the philosophy and values of understanding this, the common area which have risk identified by the company from past experience and how they handle those. Right. Okay. Does anyone have any further comments before I talk? Right. So when you look at the culture, right, we sometimes say, okay, this is how they do this. Okay, for example, you go to let's say you were supposed to wear a helmet when you drive motorbikes, right? Because that's a safety requirement. But if you go to certain areas, they don't wear the helmet. They just drive. That's how they do this, right? That means that's how they feel it. That's how they want to deal with it. Same situation, same scenarios. If you look at how different organizations or different groups of people respond to that, that explains what they believe about that. So what is the level of seriousness they give, right? Say even in the banking, let's say, let's go to the banking setup, right? How you take the decision, say for example, when you want to grant loans, you have certain tests, right? Evaluations that you need to do. And you are supposed to be serious in your evaluations and then follow the steps and evaluate, grant a loan. But there could be situations where certain branches, or maybe the organization as a whole, they have this practice of not paying much attention to certain things. They just downplay, right? They just believe, for example, when you are supposed to submit your identity card or identity proof to open an account, if the customer says, I forgot it, you can either say, okay, then why don't you bring that card and come? So then we will look at it. That's one way of handling it, because you don't want to take a chance on the KYC, right? Know your customer thing. Or you sometimes say, no, it's okay, don't worry. You bring it whenever you come next time. I'll process this. You see, these are the different types of actions. So the way you deal with the matters, how you look at risk. Some people are aggressive. Some people are averse, right? That means some people take more risk than the others. And some people behave in a particular way when they deal with risk. So this culture is kind of the invisible mechanism, invisible guide for people in an organization to drive their behavior, right? So it's not kind of conscious, so you don't have to think too much to execute it, because the flow, the arrangements, the practices, how others do, right? How others accept what you do, all these things established in the organization, and then you naturally tend to behave in that way. Right? That's how you deal with it. So that's the culture. That's the culture of the organization. In simple terms, how people behave, how people make decisions in an organization. So you can have an organizational culture throughout the organization. You can see sometimes the same culture being practiced, or sometimes we can see when you have geographical locations, geographically things can change. Sometimes the head office culture is different to a branch culture. Even branch culture, you can see in different branches, different regions, you may have different cultures. Or sometimes you can have within the head office even, right, within the same building, each functions, each department may have different cultures among themselves, how they practice this. So therefore, that drives the behavior, and as a result, it has an implication on risk. Remember, when you talk about operational risk, we talk about processes, systems, people, and external event. So this people factor is heavily influenced by the culture, right? How people work, how people do things, how careful or careless when they do certain things. Say, for example, there are certain sensitive documents, information you handle. Sometimes there could be a culture within the department, they just don't care about the sensitivity of the information, they just let the files lying on your desk. But there can be certain departments, they are very serious about the sensitivity or data security, and they have a practice whenever you go out of your room or out of your desk, you make sure that you put that file back in the cupboard or wherever, you don't keep anything on the table. So you have that discipline within the organization, within the department, because that's the level of risk consciousness you have. Now, we'll be discussing this again later. When you want to build an organization, or when you want to have a strong risk management setup in an organization, risk culture play a major role. So how do you inculcate that risk culture in the organization is very important, because it is not a job for the CRO alone. It is a job for the entire top management, especially the HR function. How you build this, whatever the risk profile or risk culture that you want to maintain in the organization, you identify, and then you need to keep injecting that culture to the employee from the day the employee joins the organization. You can even give that message at the interview itself, right? What kind of an organization, what is the tolerance level on certain things in your organization? You give that culture. So for example, I give you one example. I used to be a CFO for an organization before, right? I was a CFO for a hospital, and there we had I had about 100 plus people under me and different departments. And there's one segment, one large chunk of employees were there in the counters, cashiers, right? Because we have different counters at the car park and various units in the hospital, you have cashiers. So whenever we recruit at the interview, I very clearly say, I have zero tolerance on integrity. Zero tolerance on integrity, right? There's no room for you. The moment you prove that you don't have integrity, we will not think twice, we just fire the person. So we give that message at the interview itself. And then we reinforce that whenever we have meetings, discussions, and we actually do that as well, right? Even when we find a slight, they say, okay, the person has taken 100 rupees because he has a quick need, and we got to know that he has got it, and then later he apologized, okay, sir, I will not do that again, just 100 rupees, no. But doesn't matter, even if it is 100 rupees or 5 rupees, if he has taken it, that means he doesn't have integrity. We simplify that, so that the message goes to the rest of the people also, right? They know this organization, this is the level of tolerance on these things, and then what to what level they need to maintain that. So likewise, we need to first define that culture and inculcate that culture across the board with the help of all the relevant functions and the leadership And then only we can make sure that that culture is established throughout the organization. It is very important. As we move on, we will understand why I'm talking about this very much, because managing risk is not like controlling people through internal controls. No, you can't manage risk merely by having stringent internal controls. That is a different way. Internal control is one side, right? Internal control is where auditor, internal auditor, someone can say, okay, there you are supposed to sign here. Have you signed, right? You are supposed to do this check. Have you done this? You just go and see whether there is a policy and whether the people have complied with it. But that alone will not help you to build a culture or manage risk. So for you to manage risk, your culture has a major role than the controls. Right? We will discuss as we move on. Then we have something called conduct risk. Right? So as you can see, how you manage yourself, how you run your business, how your people behave in the organization or deal with the customers can have poor outcomes for customer. That means there can be a lot of disappointments to the customers. There can be a lot of distress to the customers, which will affect your financial performance. Right? That can be unethical behavior, inappropriate behavior, right? Sometimes irritating behavior to the customers, right? Certain practices, certain ways of it. That's why I told you these behaviors can lead to different things. Right? Then this is, I think, some of you mentioned earlier, right? How much risk an organization is willing to take, right? How much risk an organization is willing to take. That is, this, I must tell you, is one of the main differentiating factors. How different players in the financial market define their competition. Within the same market, look at the current context in the Sri Lankan market. Right? Those who are overseas, I think, are aware of what's going on in Sri Lanka at the moment in terms of economic landscape. In the current context, we see a lot of risks, a lot of issues, a lot of possibilities, right? Probabilities for a higher level of bad loans. Now, in a given situation like this, where there is risk for everyone, there are certain players who want to take more risk and aggressively grow their loan book. And there are certain players who do not want to take that and they play safe. I know most of the banks, right, they just now bank on pawning gold loans, right? Solid, you have some safety there. So most of the people, banks, even finance companies, they are now very reluctant to go and fund a business, cash flow lending, because you see a huge issue there. Now, this appetite is how much risk you are willing to bite. This is not a theoretical thing, or this is not a regulatory thing. This is purely a choice that the organization has to make, right? It's a choice you make, right? Whether you want to go, for example, when you go to, let's say you go on a trip, and then you see a lake, right? And some people say, okay, let's go and bath. And then there would be people who want to first check with the people in the village or someone, okay, how safe is it, right? Do we get crocodiles in it, right? Or do we have any other dangers in this lake? And then sometimes the villagers might say, yeah, there are 2 crocodiles in this lake. It's a big lake. They generally appear after 4 o'clock. Now it is 2 o'clock. And they generally, hang around on the other side of the lake. But on and off, they come to this side as well. So now there is some kind of a risk. And then out of the lot who are there, some might decide, let me not bath here. Right? Let me go to the hotel and have a shower. But there can be people, let me anyway, have a bath. I want to jump to the lake and enjoy. So the same situation, 2 different reactions. Right? The guy who wants to have a bath there is an aggressive risk taker, want to take the risk and enjoy that. The other one is a risk averse guy, just avoid the danger. So it's a choice, right? The same goes with the organization as well, the banks. So the board of directors and the risk committee, the management, they all together decide, okay, how much risk we are going to bite. So that will define the rest of your management of the organization. And also this risk appetite needs to go in line with your risk culture. Now see how it works, right? If your risk appetite is a risk averse situation, okay, you don't want to take too much risk. You are very careful of your risks, right? You don't want to take risk easily. You will take all precautions before you execute something. And that is the level of risk that you want to buy. That is what the expectation of the top management. But when you go down, if your culture doesn't support that, right? If your culture, the people have not grown to that level, people are very casual and they just take risk very easily. Then what happens is your appetite is something, your culture is against the appetite. Then your organization cannot execute your risk policy because your culture doesn't support your risk appetite. Now see how you need to connect the 2. Right? Then we have another term called inherent or gross risk. Right? So that is when you assess the risk or quantify or measure the risk, you look at the risk without considering any mitigating factors. Right? That means you assume there are no controls. Assume there are no ways of mitigating it. What is the maximum damage? So let's say you want to drive a motorbike and you don't wear a helmet and you drive it. So what is the danger? What is the damage it can cause you if you meet with an accident? And without a helmet, what is the damage? And that is the inherent risk, right? Without any control, what could be the exposure? Let's say if you lend, let's say you lend 1 million to a customer and you assume that you lend without a collateral. So what is the maximum? That is 1 million in that example. Then we have the residual risk. That is after considering the mitigating controls, right? Okay, I drive the bike and I'm going to wear a helmet. If I meet with an accident, what would be the impact? I will still have some level of impact to my head, but that is not as bad as it could be without the helmet. So then I look at the net result, right? With the helmet, what could be the impact? Likewise, the other example I took, I give 1 million loan and I keep a collateral for 500,000. So my exposure, net exposure is 500,000 because 500,000 is already covered with the collateral. If the customer goes bankrupt or anything, I still can manage 50% of it. Then we have the risk profile. That is the holistic exposure of an organization in terms of risk. What is the total exposure to different kinds of risks? and to what level. It's just kind of a map. Okay, it's like when you go and take a medical check from a hospital, you get a diagnostic report, right, on your health aspect. Same way, if you look at a diagnostic report on your risk for the organization, what are the different kinds of risk and to what level you have the exposure on those things, you get a map. That's the risk profile. Then how do you mitigate? So we identify the risk, you measure it, right? We look at different aspects, then how you mitigate. So whatever the type of risk, right, depending on the risk type or the level, you have different ways of handling it. The techniques, right? You need one, you can have insurance policies. What do you do with insurance policies? You outsource the risk. That means the risk that you may have to incur. Let's say if you meet with an accident, you don't have to worry about the total loss because you have paid an insurance to a third party and you have passed the risk to that party. So whatever the loss that you have to incur, that party will now take care of. You are passing your risk to someone else, right? Then you need to have system controls to upgrade. So mostly when you talk about controls, you talk about preventive control. That means controls that do not leave a room for any risk, right? You prevent it happening. You can have other aspects as well. Then hedging. What do you mean by hedging? Does anyone know what hedging is? What is hedging? Sri Lanka was, I think this topic was very popular some time ago.
Low link with the price.
Sorry?
The product is there's a maximum cap in a which called Sri Lanka had a hedging facility with Standard Chartered for oil. So they hedge for that particular product at some level of if it go beyond that, Standard Chartered will creep in. Other if it go below that value of that, if suppose if say $100 per barrel, Sri Lanka government have to pay. If it go beyond $100, Standard Chartered will pay for the difference. So this is you call a hedging, I think, if I'm not mistaken.
Right. Okay. But what? Yeah, you explain a bigger story there, but there is one aspect we consider as hedging, right? And that is the part we need to understand. Yes, yeah, some of the things that you mentioned were there. Okay. Let's see if I can see some response. Capital losses. Having a limit is not hedging. That's part of that hedging total structure, but the concept of hedging is slightly different. Anyone? Okay, I'll give you a different example, right? Now let's say these days we have football matches, right? So any predictions? Any predictions for the two players, two countries that can come for the finals? Anyone? Any football fan here?
Argentina.
Okay, Argentina. Okay. What will be the other one?
It can be England.
Huh?
England.
Okay. Argentina and England. Let's say Argentina and England. qualifies for the finance. And you want to have a bet, right? You go to a friend and say, look here, I'll bet you, right, 100,000 Argentina will win. So if Argentina wins, you're up on the deal. If they lose, you also lose. Then sometime later, you have a doubt about Argentina's winning, and you have a worry if they fail, I am going to lose my money. So what you do is you go to another friend and have a bet with him and say, okay, I'm going to have a bet with you. I think England will win. Right? Then you go and have that bet with that guy. Maybe you can have the same amount, 100,000. So what did you do? What will happen with the outcome? So you have two bets now. What will happen with the outcome?
Nil effect.
Yes. Whoever wins, you're not going to lose. Right? So that mechanism is called hedging, because you had an exposure on one side. You have a deal with a guy, a bet with the guy saying that Argentina will win. So you have an exposure in case Argentina loses, you're going to lose that money. Therefore, you go and have another arrangement that says that has nothing to do with this. So you have one agreement on this side, you have a separate deal on the other side. In case I lost here, I'm going to recover from this one. So having another arrangement which acts in the opposite direction in case of a event is called hedging. So same way, for example, I borrow from dollars, right? I borrow from dollars. Then I have to repay that. So if there's an exchange rate increase, I'm going to lose. I have a exchange exposure because I'm going to have a huge exchange loss. So to mitigate that, I keep that deal apart, and then I go and invest in another country in dollars. So on one side, I have a dollar borrowing. On the other side, I have a dollar investment. So with that, if the exchange rate goes up, I'm losing on the borrowing, I'm gaining from the investment. If it goes down, I'm losing from the investment, I'm earning from the borrowing. So that the impact on me is mitigated with that arrangement, two different arrangements from two sides. And that mechanism is called hedging in very simple terms. But when you cut a hedging deal, when you structure a hedging deal with a party, it has a lot of technicalities involved in it. So don't worry about that. But the mechanism of hedging is that, right? Having an opposite impact on you for a deal that you already have with an independent arrangement separately, so that the impact of this will be nullified on the impact of the other, right? That's the idea of hedging. We'll discuss that in detail later. Then holding collateral against the credit risk, right? That we all know, right? When you have a collateral, in case the customer doesn't pay, you have the backup for the collateral. Then we come to risk in financial services, right? We've been discussing about the risk in general all this time. So financial services. Now, all these risks we have discussed. We know in a broader sense what these are. So operational risks I have discussed earlier. Credit risk we all know. The possibility of not being able to recover the amount or the capital amount and the interest from a borrower. The market risk is the price fluctuation, right? And the liquid risk is not having sufficient liquidity or the cash or cash equivalent in the organization to meet the demands. And there's another one called the funding liquidity risk. The liquidity is about the availability of cash and cash equivalent. That is basically the cash liquidity. Right? We all know that. Funding liquidity means not having adequate liquidity on the funding side. Right? Who funds the bank? Right? Who funds the bank? Who funds the bank? There are three major parties who funds the bank.
Shareholders,
Shareholders,
customers
or depositors.
Depositors, and
Who else?
Lenders.
Lenders. Right? Those are the major parties who finance a bank. Then not having adequate sources of funding, not having adequate money collected from that side, you have the funding liquidity risk. In the current context, most of the banks face this because people are finding it difficult to manage their living costs. Therefore, they pull their money from the system, and they, even though you are offering a higher interest rate, most of the people don't have money to go and park in the banks. Then they find it difficult to, banks are finding it difficult to have. That's the reason why you can see even these highly rated state banks are offering dumping interest rate, sometimes over and above what finance companies offer. So it should be other way around, right? When you say a safe bank, they offer a lower rate. A risky organization will have a higher interest rate. Now you see even the safer banks are offering higher rates because, not because of the risk factor from that side, but because they are running out of liquidity. They need to now attract that liquidity available in the market. So banks are competing each other to attract the limited liquidity in the market to their side. Then we have the interest rate risk. That is when you lock yourself for a particular interest, investment or borrowing or lending, anything. When the interest rate goes up and down, your return will not fluctuate because you have locked yourself. Therefore, you have deposited in a fixed deposit at a particular rate for 5 years. Let's say you have deposited some amount at 20% for 5 years, and the market interest rates go up. Right? After 6 months, it goes to 25%. Now you have blocked yourself. You are losing 5% there. So that's the risk that you take. Right? It works other way around for the bank. Now this is important. As I discussed this, the last segment, you don't see those risk types in the typical organizations, right? Those things are available only in the financial services sector. Now this grid explains, right, how the risk profile or the mix of the risk categories change in the financial services sector. As we go towards the right hand side, the credit liquidity market investments, those kinds of specific risks that are unique to financial services markets, right? That risk factor is going up, right? Those risks are going up, unlike the other sectors. But as you can see, the strategic and operational risk and the other risk exposures are more or less the same. The environment is the same for all, right? The external risk factors are the same for everyone. Right? And strategic risk, operational risk similarly affect depending on how you handle it. But the other types that I mentioned earlier at the later stage, those are unique in the financial services sector. And some of the features in the financial services industry, they are very complex. The transactions are complex, their products are complex, their processes are complex, right? You know how a bank is run compared to a normal organization. So number of transactions per day, the volume, right? These are all complex things. And the other thing is, they don't have physical product, right? When you open a deposit, your deposit certificate is not the product. It's just a proof. Your passbook is not the product. Your credit card is not the product, right? That is just a indication, or that's a proof. Your product is the facility, right? The borrowing or lending, right? So if you destroy your credit card, you can get another one, right? That means And then lifespan. If you sometimes there are loan facilities, housing loan facilities, depending on your age, you can take maybe 20 years, 25 years, right? Long term products are there compared to other industries. Then in the current context, these are not options, right? You have to deal with it. These are normal businesses. You have those. So these complexities, these risk profiles, they are given, right? If you are in that business, if, for example, if someone asks me, what is the business of banks? For me, they are in the business of dealing with risk, right? You're playing with risk. So depending on how best you play with the risk, you can be ahead of the game. That's what it is in the banking sector, right? How good are you in dealing with it? How good are you in milking? You get into the risk, you milk it, and you manage the risk, right? Now, most of the organization, banks these days, they face a huge problem. What is that? Impairment. Impairment is the biggest headache because how you deal with the risk, right? How you mitigate your risk when you lend. Those who are in the banking sector knows what I'm talking about. Right. So that's the end of this chapter, but there are a few new additions to this chapter with the latest version in terms of technology and cybersecurity aspects. I'll touch upon it later when I talk about the revision, because these are very minor areas that have been brought in at the last minute when the book was launched, but I'll be capturing it later at the revision if I do not get it in the middle. So what I would do now is, let me first ask if you have any question, clarification on what I have discussed up to now. Anyone? Any doubts, clarifications on anything I have discussed up to now? Or different views? Great. So we'll take a quick break now, right? About 15 minutes. Yeah, now 8:30, 8:45. So I'm going to start a new chapter.
So how long does this class go for?
9:30, 9:30.
Okay. Yeah, sure.
Can we log off now?
Yeah, you can log off and come back, it doesn't matter. 8:45, make sure you come back by 8:45.
Okay, all right, thank you so much.
40 or 50 minutes, we are already 8:35 now, right? We come back as fast as possible.
Okay.
Okay. Can you see the screen?
Yes, sir.
Yes.
Yes, we can see the screen.
Yes, hi. I just came. Did you start already, sir?
Yeah, yes, it's starting. Right. Now we are going to the second chapter, that is international risk regulation. So the exam weight is 7% for this one. So this organization, right, there's an organization called Bank for International Settlements. How many of you know this? How many of you know what this is? Any idea? Bank for International Settlement. First time. What do you mean by first time? First time you are in the class or first time you heard of it?
First time I'm hearing about this, sir.
Okay. Anyone else hearing it for the first time?
Yeah, even
So-
me, first time I'm hearing about this actually.
Okay. Okay. Interesting. Yeah. No worries. Bank for it. So what you think it is? Right? What could this be? Unfortunately, the term doesn't really sound, it doesn't really give the exact nature of this organization. Some people might think it's kind of a clearing agency, right? It's like we have Lanka Clear, right? Check clearing or any electronic transaction clearing or center hub or something. It is actually not like that. It is something that we all need to know anyway, right? Especially if you are dealing with the banking sector. This is the history of this organization. Sounds familiar? Basel, right? We talk about Basel, right? Principles in the banking sector, Basel 1, Basel 2, now we talk about Basel 3. So Basel is a city in Switzerland, like Geneva, right? Now, some of you might have already got an idea that this institution has something to do with Basel guidelines, probably. If you assume so, yes, you're correct. We'll get to know in later. So in very simple terms, this organization is the bank for central banks. It's like this. Let me use the notation. You have Central Bank of Sri Lanka, right? CBSL. What is the Central Bank of India? What do you call it? Anyone know?
Reserve Bank. Reserve Bank of
RBI.
Reserve Bank of India.
Yeah. So we have people from UAE. What is the equivalent in your area?
Central Bank of UAE.
Sorry?
Central Bank of UAE.
Central Bank of UAE. Right? So what are these? Do they accept deposits and lend money to customers or people? Can we get a loan from central bank? We cannot. It's a bank,
They are
but
the bankers to the government.
yes, bankers. Not even the government can borrow like that, right? Like not like
Yeah,
the way we do it in a normal bank. They are the regulator.
Regulators. Yeah.
Right? They're the regulator. That is the institute that controls the banking system in that particular region of the country. Right? That is, in other words, they are the financial controller of the country. The country's financial landscape is governed by them. They decide how much money should be there in the circulation. So they have the authority to print money. They decide the interest rates, right, of the country. They set the standard, and based on that, the other banks will benchmark their policy rate and do that. They have control over exchange rate, how they want to monitor that. So all these financial aspects, and they are the monitoring authority of the banking system, right? They regulate the banks, they monitor the bank. So they issue circulars right? How the bank should be run. They issue license to the banks. You cannot run a bank without getting the license from central bank. So likewise, they are very powerful. They are the regulator. And then you have banks for international settlement. The customers of BIS are the central banks. Right? BIS deals with the central banks across the globe. That's why it says it serves as a bank for central banks. They're the bank of, this party is the bank of central banks. It doesn't mean that the central banks will go and borrow money from them. That is not the role they play. They have the capacity, bandwidth, expertise to do in-depth research, analysis, and then what they do is they support the central banks throughout the world in terms of knowledge, policy framework, and other guidelines, so that the central banks can do their job better. Say, for example, Basel principles is one, right? They do their homework, they come up with a model, they come up with recommendation and say, if you want to run the banking system of your country, these are the standards you can follow, right? These are the guidelines you can adhere to. So that will help you to manage the banking system much more effective. So they prescribe those guidelines. They give guidelines. So the central banks can go to them when they have any clarification or when they need any support. That's the role they play. And you can't have the banks, usual banks, let's say you have central bank, you have the commercial bank, Bank of Ceylon, Sampath Bank, People's Bank, all kinds of banks here, right? So these banks are dealing with the central bank here. So these banks cannot go and have a dealing with them. This is not possible. They don't deal with individual banks. This institution only deals with the central bank. Is that clear? Right. Now, I told you, they don't accept deposits, right? Like what others do. They are the supporters of central banks. And we also call them regulators, But although we use the term regulators, regulator, there's no legal binding, right? There's no legal binding. Because they only prescribes the guidelines, even Basel. It's not a regulatory pronouncement from their side. They only come up with the blueprint. This is the model. And the respective central banks can borrow that, can take that, and they decide whether they want to implement in their country or not. And they can make it a law. They can make it a rule within their country. This organization has no authority to mandate it in other countries. They can't go and say Sri Lanka must follow this. Right? It's a central bank who make a call whether we want to get it or not. And they can't even put any regulations, or they can't even punish the central banks of other countries. They only provide guidance, support, and cooperation. Right? That's why this says, right? Now, tell me if you know. Now, this institution do not deal with individual banks, right? Then we sometimes talk about individual banks having an alliance with these international banking institutions. So what is that? Right? I mean, when the banks need support internationally, when they need the help, when they want to work together, how do they do that? How do they collaborate? Because they cannot collaborate with BIS. What is that institution for? Or is there a mechanism? Any idea? How can the individual banks collaborate globally? Any idea? What is that? World Bank? World Bank is a different one. We have bankers here, right? You don't know. Who are you dealing with? What is the institution? And the banks want to collaborate.
Through SWIFT.
That's a clearing mechanism. Yeah. I'm asking, like, bank for international settlement, is there a body or a kind of a mechanism or an alliance that you find globally where individual banks can get together, that they can work as a lobby? We have in Sri Lanka, we have what do you call that? Huh? What is the body in Sri Lanka? We have the alliance of banks or banking professionals. You have banks, we have association, right? Association of banks. So internationally we have you heard of this one called International Banking Federation? International Banking Federation. That is the body, right? International Banking Federation is the body. If any individual banks want to connect globally, you get the membership there. So that is a collection of banks globally coming together as a single force so that they can discuss the matters connected to them, and they can also be an influencer to the rest of the stakeholders representing the banking community when they want to highlight things. And also, this body can deal with BIS, Bank for International Settlement, because they represent the banking community, and on behalf of them, they can go and negotiate things and discuss and get support as well. And even, for example, when you want to implement Basel principles, right? So Bank for International Settlement, they will dictate what the principles are, what the guidelines are, and central bank will take those guidelines to their country and they make it mandatory or whatever the way they want to apply it. Then when the banks in those countries find it difficult to adopt or they need support, this International Banking Federation can help those banks, because they are an international coalition, so they can have their membership who are willing to support the other members, right? That's how you make use of that mechanism, right? So you must have heard of this term, capital adequacy. What do you mean by capital adequacy? Any idea? Capital adequacy? The term suggests adequate capital, right? Capital adequacy is whether a given bank has adequate capital. For what? Whether the bank has adequate capital to meet the risk exposure the bank is taking. So capital acts as a buffer or a cushion to absorb the risk or the shocks. And when you ascertain the total risk profile the bank is embracing, you need to prove that the bank has sufficient or adequate capital to meet any shocks or the risks coming from that. If not, the bank can go bankrupt, right? So then if the bank goes bankrupt, who's suffering? Who's suffering the most? Any idea?
Depositors.
Depositors. Who else?
Staff.
Okay, staff.
Shareholders.
Shareholders, right? First and foremost, the shareholders. Then you go to the depositors, and then you go to the rest of the people. So if you look at these Basel principles, most of these Basel principles are revolved around capital. So they talk about preserving the capital. When you preserve the capital, when you build immunity there, then there is a lesser chance for the bank to fail because you have sufficient capital buffer to meet it. So we look at capital in different levels. I'll talk about that later, right? So this capital requirement, right, is dictated through the Basel principles, right? So if you are in a banking setup, you know how these capital adequacies ascertained. So how you calculate. So there are different ways of looking at it, but there's something called core capital, right? What is the capital base of a bank? And we make an assessment. You take the loan portfolio, and then we weight those loans using a risk weightage, right? So there is a given weight that you need to put on different category of loans or the assets in the organization. There are, if you don't have a risk, you can make it zero risk, especially when you deal with the central bank and certain reserves, they can send this a zero. But when you have loans, leases, and various facilities, the guideline gives you a weight or a percentage. You convert that amount using that percentage. What is the risk in your balance sheet, especially the loan portfolio? Then once you identify that risk-weighted asset, right? Risk-weighted asset or risk-weighted portfolio, there's a given percentage which they identify as the ideal or the minimum to have. You need to make sure that you have a capital amount that is equal or more than that amount you calculate based on the risk-weighted assets. Say, for example, let's say your loan portfolio is 100 million. and there are certain loans in that portfolio less riskier, then you can discount it. So then you take the risk weighted, right? With the risk, your total portfolio could be, let's say, 80 million, right? 80 million is your portfolio. Then the Basel principle says your capital adequacy, we look at two levels. You call it primary and extended, or core capital or supplementary capital. Core capital is the main part, that is your equity and the direct capital component. Supplementary capital can include other reserves, etc. But let's go for the core capital thing, right? Tier 1. So the Basel says, okay, you need to have minimum 10%. So 10% is not the exact figure. I'm just giving you an example here, right? Because these rates keep on changing time to time. So if the Basel says a reasonable bank must have minimum of 10% of their risk-weighted assets as capital. So in the example I gave you, I told you it's 80 million. That's what we got earlier. If the Basel says the core capital should be 10%, we calculate 10% of 80 million, that is 8 million. That means your minimum capital amount should be 8 million in the balance sheet. So if you don't have 8 million, you have a problem with capital adequacy. That's how you do that. Next. I told you different types of capital we consider. There are two types. The one is called economic capital. That means the bank's version, you don't look at the regulator, how much the regulator wants you to maintain. You being very realistic about your portfolio and the risk that you take, and then you decide what would be the idea. So most of the cases, those banks who have very stringent risk management policies, they keep a extra buffer. They keep a comfortable buffer for your capital. Therefore, they estimate the requirement as little higher than what the regulator says. Then the regulatory capital means the regulator dictates. The regulator dictates based on the Basel guidelines. Right? So your economic capital can be more than the regulatory capital, because anyway the regulatory capital should be the minimum. Now we talk about the Basel Committee. I told you earlier also, it's a city in Switzerland, and there's a committee called Basel Committee on Banking Supervision, BCBS. So this committee is the global standard setter. I told you earlier. We call it prudential regulations of banks. This term prudential regulation is used because prudence means the safety, security. Right. So when the banks report to the central bank their capital adequacy, liquidity, certain ratios that the central bank is asking, we call that prudential reporting. That means because these are the reportings to ensure your safety and to show the regulator that you are having a comfortable situation in managing the risk. Now, this committee is the main. Yes, Prabhat, you have raised your hand. You have a question?
Yes. Can you please differentiate between the two capital again, that regulation capital and bank capital?
Okay.
Economic capital, yes. Is it the issued capital?
Okay.
Or?
It's like this. Let's say the central bank say, according to their rules, they have a formula. They say you need to maintain a minimum of X percentage of your risk-weighted assets as your capital. That's their requirement as per the rules. They say, okay, you need 10% of your risk-weighted assets as your capital. So in my previous example, my risk-weighted asset was 80 million. 10% means 8 million. So for the regulator, if you have 8%, 8 million or more in your capital, you are done. That means you have met the regulator's requirement. On top of it, when you manage your bank, the management of the bank, the directors or the management of the bank can have their own standards in maintaining capital. They say, we respect the regulator's limit, right? And you have no way that you can go down. You can always go up. And you can have your own benchmark. We believe, based on the portfolio we maintain, our capital level should be not 10%. We believe it should be 15%. So based on your tolerance, you define your level. So the bank can decide what they want. That's what we call economic capital, because that is based on their best estimate. That might be different to the regulators. Correct?
Right. Yes. Sorry. Thank you.
But technically, it can't be below the regulator because regulators is the minimum.
Yeah.
Right. Now, this I told you this Basel committee. So then their requirements. So they are trying to set guidelines or standards. So when they set standards, they set standards based on their research findings, and there are certain principles. I'm going to take you to a very interesting area after this. So they will set the minimum standards. But these are the minimum you need to have. This includes all what we go through today, right, in the banking sector based on the banking guidelines. Most of them are from this. Capital adequacy, certain reporting, certain restrictions on investments, right? Certain restrictions on distribution of resources. So lot of operations are there. It's not only on capital. And they also talk about the supervisory concerns and how to deal with it. Right? And this institution, this committee, because we're talking about the committee within the within BIS, so they also need to have collaboration, support across the board, so that they have these connections and communication among them as well to support. Now this slide, right? You have 29, you have core principles, right? You have core principles. When you supervise a bank, when you monitor a bank, especially for central bank, when they do their job, they need certain guidance and approaches to do their job, right? How you go and supervise banks. When you do that, you need some principles or guidelines. So accordingly, they have come up with 29 core principles, right? So out of these 29 principles, 1 to 13, it's about the central bank's role, right? What are the supervisory powers, responsibilities, and functions of the regulator or the central bank? Then we have another set, 14 to 29. Those guidelines are for banks, right? The standards that the banks are expected to maintain, which will be reviewed or audited or monitored by the regulator during their supervision. Now, we have discussed the role of BIS and then the role of this Basel committee and what they do. And you also discussed 29 principles to support the banking system if you do this. Now, this area is important in that, because what it says is you can define a nice set of principles. Right? You can define a nice set of principles with guidelines, all good. But for you to make use of them, to effectively implement it, there are preconditions. It is like you can bring down a Lamborghini to this country, right? You can bring down a Lamborghini, a good vehicle, luxury vehicle. Right? But if the roads are not geared to handle it, you can't get the best out of it. You know, those are kind of super power cars, right? You can't get a Lamborghini to go on a road like, you know, these buses, right? There is a level of performance those vehicles are expected to have when they run on the roads. And you need to have that space. And also, if you look at in the Sri Lankan context, right, the bumps and all the damages on the road, you know the ground clearance of those vehicles are very low, right? Maybe 1 inch, 2 inch, very small gap between the vehicle and the floor. So if you have a bump, you can't go there. So the point there is that if you want to bring down a Lamborghini here and you want to enjoy the ride, you want to use it properly, you need proper infrastructure that facilitates the performance of that vehicle. You need the roads that supports driving a Lamborghini. The same way, what this topic is talking about is when they dictate those principles, they are good, you can get a lot out of it, but for you to implement those principles, there are certain preconditions. If these preconditions are not in place, these principles are useless. You cannot get the merits of them. So what are those preconditions? Number one, sound and sustainable macroeconomic policies. If a country doesn't have a sound and sustainable macroeconomic policies, you cannot expect the central bank to run a smooth job. If the governments change the policies every other day and you don't have continuity, how can you expect a banking system to operate smoothly? Right? How can you expect these governance and the rest of the parameters to operate smoothly? So that's a problem. Therefore, this is a precondition: sound and sustainable macroeconomic policies. Well-established framework for financial stability policy formulation. That is, for you to establish financial stability within the country, there has to be a properly defined framework. People can't come out of the blue randomly, the president or whoever, right? Can't all of a sudden appear and say, we are going to do this, we are going to do that, right? That doesn't work. You need a proper mechanism, not individual, not ad hoc. There is a mechanism that identifies the policy gap and then identify the action plans to address it. So there has to be a framework. Then also you need a public infrastructure to operate. Because remember, when you say bank, What do? Banks are there not to serve banks. No. Banks are there to serve people. Banks are there to serve businesses. Therefore, in order for banks to do well, you also need other elements of the society, other elements in the community addressed well. That's why it says well-established private property laws and business laws. Why? If you don't have established property laws and business laws, the banks may not be able to deal with the customers on those lines. Say, for example, property laws. If you don't have good property laws, how can a bank take a land as a collateral? Because there could be issues. Your collateral may not be clean, right? If you don't have proper laws to govern that control, then you have the ability to use it. So that's one. Then rules governing financial markets. Right? You need to be able to control and monitor the financial markets, because these markets can be heavily abused and these markets can be mishandled by various parties. Therefore, it's very important for the regulator to have the guidelines and monitoring for those. Then well-regulated accounting, auditing, and legal professions, because these professions are important because these governance principles are deployed with the intention of supporting the banks, and there has to be certain professional involvement to make sure that this implementation is intact, and then you need to follow up and see whether it happens. It also covers the legal aspects. Efficient payment system for settlements of financial transactions, right? That again is important. Your payment systems, payment gateways, the clearing agencies, right? That is what the Lanka Clear is doing in Sri Lankan context. So likewise, you need those mechanisms for the parties to deal with and for them to operate. Then the last point, when you do these things in the market, there is a possibility that you get exposed, right, on lawsuits. So various avenues are there to get exposed. Then we need independent judiciary, because if the judiciary doesn't work, how can a bank expect the rest of the people to be controlled? For example, if you lend money and if the customer doesn't pay, you should be able to go and seek legal assistance, right? There has to be some kind of enforceability there. So for that, you need an independent judiciary without bias, so that they will facilitate the rest. Then we are talking about the national preconditions. The list I just mentioned was coming under the third point. Then the fourth point, a clear framework of financial crisis management, recovery, and resolution. Very important, right? In the company, when the country is in trouble, when there is a shock to the financial services sector, or maybe an institution within the sector or industry, there has to be a clearly defined framework and arrangement to ensure that we recover fast and we preserve, right? Preserve the investments of the depositors, because we know the banking system fails, everything else will fail. So the central banks always take measures to make sure that they address those fundamentals, so not to allow the banks to fail. So they need to have this crisis management principle. And then mechanism for providing an appropriate level of systemic protection of public safety net. What do you mean by systemic protection? What do you mean by systemic risk? Any idea? Systemic protection? Does anyone know this? Have you heard of the term systemically important banks or systemic banks? Heard of? Have you heard of this? Systemically important bank or systemic bank? No. Right. We call it systemic bank or systemically important bank. So there is something called systemic risk. The systemic risk means the risk of a failure in the banking system. Right? The entire banking system can collapse. It's a disaster. So that is a systemic risk. So we identify a set of banks within the industry as systemically important banks. In other words, these are the banks we call too big to fail, right? Because if any of these banks fail, it can lead to a failure in the entire industry. That is a disaster for any economy. Therefore, there has to be a mechanism within a country to prevent such instances. Right? You need to have a mechanism that you do not allow the system to fail. You have various other arrangements. If you can recall, some time ago, there was an issue, the golden key issue, right, in the Selinco group. When that happens, if you can recall, there was a problem for the Ceylon bank, right? People started withdrawing their money from the bank because of that golden key matter that got highlighted. People were worried about it. And there was a panic withdrawal by the depositors. And that could have been a disaster if the bank fails, and it could lead to issues in the other banks as well, because they are heavily connected. So what the central bank did was they took the control over the bank, and they appointed an interim board of directors, right, drawing some people from Bank of Ceylon and various other state banks and independent professionals. They put them on the board and they gave the assurance to the public, yes, there's a problem with the Selinco group, but we assure you that Ceylon Bank will not fail, right? So we have taken some steps to ensure the stability of the bank. Because they did that at that point because Ceylon was a systemically important bank, right? If you let that bank fail, you are letting the entire system to fail. That's why the government and the regulator must have mechanisms and tools to deal with it. But the question we have today is that whether we have enough capacity and bandwidth to deal with the financial market, because we have quite a number of players and quite big. Right? I think in my view, we have too many financial institutions in this country. That's how many finance companies and how many banks. We don't need so many. But then there are more than anything, rather than serving the customers, there is a huge competition among themselves. At the end of the day, the customers suffer. Right. Then finally, we need effective market discipline. What do you mean by market discipline? You need to discipline the markets, right? So if the markets start malfunctioning, they are not operated well, then the regulator or the banking system cannot function. Now, from exam point of view, this is a popular area of the examiner, right? I have seen in the past papers when we discussed, we'll see. So these 6 national preconditions you need to know well. Remember, you have to, whatever the way, keep in mind, right? Find a way to remember this, by heart this or whatever. There has been regular questions on this line, the national preconditions. And they sometimes go to the extent of asking the number. What is the 6th one there? What is the 4th one there? Something like that. They don't ask what, but they give some statement you need to pick. Therefore,
you mean to say these are like in order, is it?
Not in order, but there is a number given 1, 2, 3, 4, 5.
Yeah, so we have to remember it in order.
Sorry?
So does that mean we have to remember it in the same order as this?
Yes, yes, yes. Better remember in the same order. Because when the exam comes, that's why you find a way to remember this in the order, then you won't forget it, right? at least you identify some keywords there, right? Remember keyword with the number, right? Sound first, right? Infrastructure 3, right? Something like that. Right, I think the time is up. It's 9:35. I have a few more points there, but we can discuss this later. Any questions? Any questions, clarifications?
So one question, when we say BIS, are we really talking only about the Basel Committee, or do we have anything else in it?
BIS is a large organization. As we discussed, it has several tasks in that. But from an exam point of view, their focus is mainly on the Basel Committee, because that's the most relevant component in BIS that governs the banking system.
Okay, so we do have other sections in it.
They have, because they can have their branches and committees and all that. They are not just banks, so they are looking at the financial system across the board, right? Okay. So they will have other guidelines like these terrorist financing, money laundering, AML, all those things. They have a lot of stuff, right? They are an international body that supports the banking system.
Okay, sir. Thank you, sir.
But this is more or less I would say, the bread and butter. This is the main thing.
Okay. Thank you, sir.
Any other questions?
So will you be able to explain about the core capital, like the components of tier 1, tier 2, tier 3, and the subsequent capital, if you don't mind?
Yeah. It's kind of a little lengthy one, but if you bear with me, can I discuss it next time?
Yeah, sure, sir.
Because the time, because we have pillar 1, pillar 2, pillar 3. There's another part we need to know, right? And then we have core capital, supplementary capital, and all that. So I'll clarify all that, because I can't do it in a rush, so that the others will get confused. Remind me the next time. I will definitely do that.
Right. Okay. Thank you, sir.
Anyone? Right. If you don't have any further, we'll meet next week. I'll continue the rest. Good night.
Good night, sir.
Good night, sir.
Good night.
Good night, sir. Good night.